Hello, everybody. Welcome to the Fintech Combine. I am your host, Kris Kovacs, and this right here is the series where we talk about community-based institutions, their business and digital transformation projects, and we meet the innovators, entrepreneurs, and fintechs that make it all possible. On this episode, we interview John Deering, partner at Capstone Strategic, about the services they provide credit unions and CUSOs who are interested in investment activities in fintechs. So if you're ready, let's suit up and get out on the field. John, it's so great to have you on the show today. Thank you very much for joining us.
Well, thanks, Kris. It's a delight to be with you today.
So tell us a little bit about your firm and what services you provide CUSOs in the industry.
Sure. Capstone Strategic is a primarily buy-side acquisition firm. So we work for folks that are interested in expanding proactively in the world of acquisitions and using that as a tool to enter a new market, expand their breadth, things of that nature. That's our bread and butter. We also assist clients with exits as well. So folks that have an interest in changing their cap table, finding a good home, etc. So those are our two main forays into the world of credit unions. I happen to lead the CUSO practice for Capstone. And been doing that for about 20 years now. And it's a lot of fun, great market to be in right now.
So tell me a little bit about, like, over that 20-year period, what kind of changes have you seen in CUSOs? It could be the type of CUSO or what the kind of work they're doing. What have you seen in your time frame working with CUSOs?
Sure. I think, there's been three different chapters, at least in Capstone's storyline with CUSOs, and it kind of follows the trend lines that we're seeing out there in the community. So early on, there were a lot of cost savings related CUSOs that were out there that we were assisting, and that was all about trying to generate additional scale. That was about trying to add additional credit unions to the usage for that particular CUSO services so they could expand it over a wider population, if you will. Chapter 2 is continuing today, and that is the influx of the fintech community coming in and helping credit unions to expand and thrive in different ways. So that was a full-on new chapter that I would say really, 5-6 years ago started to really inject energy into the space. And it really has not plateaued, it's expanded and snowballed since then. And every year there's more and more of that type of activity. So what that means is every time a credit union puts a dollar to work in an organization that's privately held or owned by institutional investors or entrepreneurs, they become a CUSO, and then you're off and running in a different CUSO chapter. And the third one, I think, is running in parallel right now, and that is CUSOs that folks are standing up and or expanding into that are assisting with either breadth of product and service to be able to take care of or not take care of, adjust, if you will, the credit union service platform for generational wealth transfer or trying to get deeper through insurance products or financial literacy, wealth management, all of those kind of things that I call it what's old is what's new. Some of those things have been tried and true in the marketplace for years, but they've come back in a different way with the technology on top of it.
So, and that's, thank you for making the distinction. When a privately held business or any kind of business accepts credit union investment dollars, not necessarily serving a credit union, but when you accept credit union investment dollars, you then fit the definition of a credit union service organization or a CUSO. Did I get that right?
That is correct. The other side of that coin is if they're not serving credit unions now or credit union members, they better have a plan to do so because there's the primarily served rule that you must adhere to. So, but to your point, and playing off of what I said, absolutely, the $1 rule applies that if a cap table is 5 entrepreneurs and a credit union wants to get involved in that organization on the on the cap table and invest in them for directional purposes or expansion of opportunity or
Hmm.
expansion of their roadmap in some form or fashion. As soon as they join those entrepreneurs on the cap table at 1% or 99% or 100% or 51%, it will fall under the CUSO classification, as you said.
Gotcha. Thank you. And that concludes our legal corner of the day.
I am not an attorney, yes, and nor is Kris. So yes, yes.
Neither of us are attorneys. You need to go talk to our friends at Messick and Lauer, right?
There you go. Absolutely,
That's
absolutely.
awesome. So, how did you get started in this business? Like you said, you've been there for 20 years. Like, what did you do before that, and what has really retained your time and attention and your passion for so long to really continue to be a part of this?
So the credit union chapter has been about 20 years. I've been with Capstone 28 now. So I joined Capstone right out of business school. At the time, I was thinking that I was going to use grad school as a transition to get up to Manhattan and get into the big bad world of investment banking.
Hmm.
And at the time, I was also working at the Export Import Bank here in Washington, D.C., doing trade finance in Argentina and Chile. So I had accounting skills, finance background, book knowledge
Hmm.
of transactions and M&A and valuation, but a keen interest in it. So during my search, I met up with the founder of Capstone, and this is back in I joined in May of '96, so it's been a good long time. And I found that I hit it off with him because he had a real big passion for the model that was forming at Capstone at the time, and that was people were engaging consulting firms and investment banks and market research houses, right? So you
Hmm.
engage with the strategy consultants at the beginning of the process to try to figure out the sandbox in which you're going to play in, for
Hmm.
example, and some strategies for moving forward. Then those folks would walk away and hand you a great report. And then part two of that is the market research firms that come and go and hand you another report and hope that the leadership group and the organization can actually execute it on their own. And then on the transaction side, you have the investment bankers and brokers that are just throwing deals at folks
Hmm.
because they're going to get paid if they sell them. So Capstone's approach and model that he had formulated was to bring all three of those disciplines in a seamless fashion in a consulting way to clients.
Hmm.
And as I said at the time, and I still do believe in that model. We've honed it obviously over the past 28 years now to be a bit more efficient and a bit more effective for our clients. But
Hmm.
that's how I got into it. Was enjoyed listening to the founder. We hit it off and been with him ever since. 6-7 months into his journey. So um,
Okay.
that's how it all began for John Deering. The Capstone story in the credit union space
Hmm.
started about 20 years ago, to be
Gotcha.
clear. So
Okay.
we're generalists when it comes to marketplaces, Kris. So we've worked in over 120 different industries. I've just found a home
Mm.
in the credit union community and really love the people. You asked the question, why do I still have an interest and passion in Capstone? And it's the people. It's the people on
Hmm.
our team, the people at our clients. Part two of that story is the diversity of projects and industries that we get involved in.
Hmm.
Because I say we work in 120 industries, credit unions being one, and then CUSOs being about 30 under that, because there's so CUSOs touch every different marketplace that's out
Hmm.
there. So the diversity is answer two.
So, are credit unions or CUSOs the typical customer that approaches Capstone for services?
Usually it's the credit union
Okay.
because they're owners in the CUSO, but ultimately we may end up working hand in hand with the CUSO leadership, depending on
Hmm.
the organization, the structure, how far along they are in their maturity and the life cycle of their CUSO. So if they have, for example, a property and casualty insurance agency that they own already as a wholly owned CUSO, but they may need additional carriers or they may want to bring the property and casualty insurance products to a new geography where the credit union's expanding. We may work with the CUSO team because they just want to do an add-on acquisition to bolster that either
Hmm.
carrier set or geography and or move from member-based insurance into business-based insurance as the trend line goes in the credit union community. Other times, credit unions start with us because they hear about CUSOs, they hear about investing in CUSOs, or they have peers that have invested in a circle fund, or they have a peer that has done something fun with a multi-owned CUSO that's shared services model, and they want to learn more about it. So there's different starting points. And in today's community, the other piece is some credit unions, as they are merging, they inherit CUSOs, and they may not want to be in that CUSO, right? Because they just inherited it through a transaction at the organization level, parent level, if you will. So they may need some help finding a new home for that CUSO or pieces of it if they're multi-owned.
Are the types of CUSOs that credit unions are interested in expanding or starting or investing in, are those changing over time? Are you seeing any trends there that are worth noting?
There's always cycles, I guess, Kris. So I would say right now there is just so much going on in a couple of different pockets, right? There's how can we get our credit union to be more efficient, because we have additional costs everywhere in the system, be it fraud related, regulatory related, compliance, however you want to phrase it. There's additional costs in the system, so they need to become more efficient. How can CUSOs assist with that in general, right? Another answer to it is we're losing revenue opportunities from bad fees. So there's a different group of folks that are focused on how do we supplant or replace some of the income opportunities that we have. There's CUSO opportunities to help with that. So these are more, challenges at the credit union system level, but I believe CUSOs are the best mousetrap in which to assist in addressing those challenges. Another trend line that we're seeing, again, is demographically driven, right? So right now you have the silvering of the the age bracket, the baby boomers. Everybody is talking about how there's going to be this massive, not only wealth transfer as folks retire, but also change in ownership of lots of different organizations out there. So there are folks that are involved in the credit union community as they try to always be there for the big transitional changes in their members' lives, be it buy a car, buy a home, get a different type of a loan, get ready for retirement, trust, wills, back of life stage as well. So I think there's lots of things going on in that landscape that lend to more CUSO activity. So we're getting a lot more inquiries around that. The other thing is, because of the second wave I described that continues in the fintech world colliding with the credit union world, there's a lot of valuation considerations out there that I didn't mention earlier that we're getting inquiries about routinely as well. And so that's an interesting dynamic, as well as credit unions try to figure out early stage investing versus more mature stage investing. So that's another trend line that credit unions are coming to us to build, policies with their board, right? Let's try to put together a portfolio theory of how much, if we're going to invest in CUSOs, how much is going to go in this type, how much is going to go in that type. They're not all created equal, and the risk tolerance is different across the board. So,
yeah, and oftentimes, unless it's some talented member on their board, right, it's quite possible that the credit union leadership team may not have any experience making those kinds of startup investments.
Oh, absolutely. It's sometimes it begins with just education. So that is a routine starting point. I was working on coming out of GAC, 3 different scope documents, just trying to outline for leadership how boards should think about the governance of CUSOs and think about how to look at, not just the options, but what do they really need to deal with on a quarterly basis, annual basis once they get into it. So, there's a lot of education required out there as new credit unions are trying to embrace CUSOs as a growth strategy.
If you're an investor as a credit union in a very early stage, say a seed round, what's the expectation for support later on, Series A, Series B, and what
Yep.
are those decision points that you're likely to have to make when those opportunities come up? I think
That's
oftentimes that's kind of a blind spot.
I agree, Chris. And it's a blind spot, and it's also one of those things we need to guide folks toward thinking about, not the worst case scenario, but
Hmm.
what is on one end of the spectrum, it's, as you said, things go hunky dory and they're self-generating
Right.
funds. Middle is more capital calls. The next
Hmm.
is, additional outside folks need to get involved. And then you have exit that you need to think about,
Right.
either when things are really going well or things are not going well, right?
Right.
So some of those
Right.
things need to be thought through and at least discussed, what those alternatives are. And
Right.
that's the other thing is a lot of the legacy CUSOs that are out there that are multi-owned CUSOs by, and I say
Hmm.
multi-owned another time, it's either wholly owned, meaning one credit union owns 100%, or multi-owned, meaning multiple credit unions, and then the derivative is multiple credit unions and other folks on the cap table, because it could be,
Right.
again, entrepreneurs and individuals as well. But we see a lot of legacy CUSOs that didn't have operating agreements that covered things like the what ifs that you said,
Hmm.
additional capital calls, or
That's
originally
right.
they thought dividends would be, start coming in 3 years, and we're in year four now,
Right.
as an example. So, you got to work through those things.
Yeah. Yeah. That is a risk management exercise, right? To understand and really set what is the appetite of the organization, not just for that initial investment, but for operating and helping govern a QSO.
That's right. That's right.
Yeah.
And some board new to boards, we'll stick with
Hmm.
that category. Folks that are new to the board of a credit union may not even know what a CUSO is, right?
Right.
So there's baseline understanding that when you do invest in a CUSO, you should expect X, Y, and Z.
Hmm.
So you need to start there and then build up.
So, where have credit unions, and obviously names have been changed to protect the innocent, right? But as an opportunity to learn the lesson, right? Where have credit unions made mistakes in investing in QSOs?
Um, oh my, so many things going through my head. I'll start with one,
Hmm.
because you said they've already gone down the path and executed on an investment. So I would say in that particular scenario, it's really about understanding what your organization is going to bring to the table to that QSO, and be clear with everybody and be aligned on what you're not going to do. So, for example, there's a category out there of folks that believe that I should only invest in a QSO and make it a QSO if we're going to utilize it wholeheartedly at our credit union. There's a whole
Hmm.
nother category of folks that said, I'm comfortable with passive investing and I'm going to
Hmm.
put money to work. And what I want is a return down the road.
Right.
I may be a pilot, but I'm not going to roll it out to the entire organization. So things like
Hmm.
that, and making sure that everybody involved in that on both the CUSO side and the credit union side are really seeing eye to eye is a big challenge, I think, out there. And I use those as two polar opposite examples on
Hmm.
purpose because there's obviously a lot of gray in between. But
Right.
that's an example of a question that you should know the answer to
Hmm.
before you get involved in this. Which seat am I in? And oh, by the way, is the rest of my organization's leadership on the same page?
Yeah.
Another comment I'll make, and we went through a little bit of this, I think, and it's slowed down, but it's I'll just use the silly example of the golf course, right? My I was golfing and somebody told me about a deal opportunity that was out there. So, I jumped in with them. And because they've, in theory, already done their homework, due diligence, checked all the
Hmm.
boxes, and I'm just providing capital alongside. So
Hmm.
there was a chapter that was occurring like that, I think, in the credit union community.
Hmm.
Unfortunately, I like to, and there's a lot. I'll use the brokers and investment banker example that I used earlier, right, where they're coming to the credit union community more than ever these days with
Hmm.
deal opportunities, right? Capital raises, folks that are on the blocks for sale, looking for new owners. So there's a lot more of that auction related activity in the community today than there was 5, 6, 10 years ago, for darn sure. And that's a totally different process to be able to have a credit union manage through an auction process, looking at a deal opportunity. And some folks just don't have the team or the skills or the expertise to do it. And they're dropping everything and putting 5 people on it for due diligence, when really the first question was never asked was, we have a strategic roadmap. How does it fit? Right? But we're going to put all this energy into it and waste that energy, in my mind, air quotes, right? Because somebody else was doing it, or it was pitched to us, and it's a hot opportunity. So I believe that the tide has turned a bit, as I said, where when we started doing what we're doing in the credit union community, there was great process and approach to building a strategic plan at the credit union. Then at the end of the meeting, at some point, somebody raised their hand and said, well, can't we grow through CUSOs or do mergers and acquisitions? And it was kind of an add-on, right? We try to bring the discipline to the table and get boards and leadership groups to think about, you can't do M&A successfully normally as a side job, as an afterthought, opportunistically, right? You need to be strategic about it. You need to be proactive about it. You need to have discipline to be successful. So I'll stop there. I went too long, but in general, that's what we have seen as some of the challenges out there in the community.
It makes me wonder. It makes me wonder if there shouldn't be a service where, obviously, every credit union needs to set their own appetite and risk, from a risk perspective. But is there somebody out there pre-vetting some of these services, some of these investment opportunities, and then playing matchmaker to say a little bit, we've vetted this, we've done the work, we know this is the type of thing you're looking for, matrix to your risk appetite. Here's one to look at, versus the other way around, which is, I heard something on a golf course, my buddy's CEO is making an investment, and I'm going to follow her in. You know what I mean? Anyway, so there's somebody's free idea for the day. Go ahead and take it.
I'm asked the question, does that exist? Right? That is a great point. And I think to some extent, there are folks that are starting to try to build that as they build the fintech ecosystems out there. And do some of that matchmaking. But again, unless you have at your credit union defined what your attractiveness criteria are for things and what that set looks like, then they all look the same. So,
that's good insight. That's a really good insight. You mentioned valuations. Let's talk a little bit about that.
Sure.
As a startup founder, I know that has changed dramatically over the last few years, right? Talk a little bit about your approach to helping perform valuations on CUSOs and or fintechs that are looking for credit union investment. Talk a little bit about your process for that, and how that's changed a little bit recently.
Sure. And I'll add the third category is credit unions looking to invest in fintech or any non-fintech to make them a CUSO. The valuation is the same requirement. So I would say the way that folks normally start valuation conversations is with the word multiples, right? Everybody wants to talk about multiples of clicks, multiples of revenue, multiples of recurring revenue, multiples of this and that, right? Depending on the organization. That's great fodder, but you don't necessarily know unless you ask 18 questions deep. Is that trailing 12 months, last fiscal year, projected? So people talk about multiples like it's the answer and it's normal. I try to counsel folks immediately away from that. Okay. So, one, there's usually 10 to 15 other items outside of price that gets a transaction done. It's the equation. It's not the number only. First answer. The second answer is sticking to valuation. Until you dig in and build a forecast and look at discounted cash flow opportunities for this, which is what we call kind of the crown jewel of valuation, until you dig in and have those insights, you don't know what it's worth to you. So seller can say, I will only exit for this multiple, but as a buyer or investor, you take that into consideration and then you have to do your own analysis, right? So the answer to your question is we try to look at multiples. We try to look at comparable deals to get those multiples to the extent they exist. That's a challenge sometimes. In the larger transactions, not necessarily in the CUSO community that we're involved in, you can even sometimes look at some public comps as well, but they're less important in the CUSO community, if at all relevant. So where we end up is putting together, looking at 3 years of history, right? Usually, if it's a startup organization or less than 3 years old, you're going to take what you can get, right? Then you're going to look at the current trend lines. You're going to versus history. You're going to look at trying to build a forecast over the next 3 to 5 to 7 years. And then you're going to start to ask the challenge questions around what it takes to grow revenue, where those investments are, what the expenses are, and build up, for example, things like what are the right add backs, right? If this is a long-term, say a second generation wealth management advisory firm that a credit union may want to get involved in, and they've been running their family expenses through this organization for 20 years, that's a very different exercise than a startup enterprise that has maybe some venture and angels or family and friend rounds in it, right? So you also need to understand what the starting point is of the organization and where you're going to get the data that's going to be relevant. So we try to triangulate across multiples and public comps and DCF to get to a weighted average. You also need to think about in valuation. The other thing that we need to educate folks on is the discount rate or the weighted average cost of capital, and working through that with clients and or sellers is, again, sometimes a challenge and sometimes a mystery, but other times it's enlightening. So we work to build up appropriate discount rates given the scenario. They're not, again, every situation is different. If you have a concentration risk, for example, in a short list of clients, or you have a concentration risk because every last sales opportunity goes through one human being, you got to take those risks into account that are specific. And when you start comparing that scenario with maybe both of those things at play, and that owner is selling, and they're also the salesperson, and they may not like your justification because of their concentration risk, because they have it all under control, and they're citing comps with another company that's maybe not concentrated and has a full team. So you have to start to kind of bridge those things as well. Long-winded way of saying valuation is more art than science, Kris.
Yeah.
There's a lot of dialogue that needs to occur. It's not cookie cutter. You need to have an understanding. The analysts need to dig in to understand what makes that business tick and where those risks are. You asked the evolution question on valuation. It depends on the market segment, right? Every market's a little different. The more mature ones are going to be more stable. The more high flyers are going to be a little less known, but usually you can find a path to any situation.
So we have a lot of entrepreneurs and fintechs who watch the show. Turn your advice around for them, right? What should they do? What could they do? What are the first three things they ought to do to increase their valuation?
Great question. I love it. So number one, top of the spear, tip of the spear, if you will, is breadth of revenue. So do not be beholden to one or two or three contracts to the best of your ability. You want to show breadth and depth. You want to be able to have referenceable clients that are going to be able to speak to you working through the challenges. You want to be able to have folks on your team be able to answer questions about the roadmap moving forward. So that means number two is you need to be clear when you're pitching, when you're talking internally and when you're communicating externally to clients, potential clients, and investors about this is where we are and this is where we're going. And these are the gaps, and we're working diligently to get. So clarity is your friend. And another thing that I'll say to increase valuation expectations, if you will, or help with that is, don't try to be everything to everybody. Customizing things in today's environment, I hate to say it, but it's more frowned upon than ever. If you have a lot of customized solutions out there that are not replicable, scalable, whatever word you want to use, that's usually leads to a lot of question marks when investors are kicking the tires. Because the question becomes, okay, you have a hockey stick here that you're going to grow over the next 3 years, but reality is you're doing 10 different things for 10 different clients right now, and they're not all going to hit, right? So you got to pick your poison and make a storyline around that. So again, focus. And then I guess I'll add a fourth. You asked three, but I'll say your team. The team needs to show well. It is a marketing process when you're going to find a buyer or an investor. And so you want to make sure you can do everything humanly possible to make sure that you have a great team around you that can speak to intelligently about whatever you're doing. And, they're going to be, they being potential investors or whoever's doing the due diligence should be, looking for different answers to the same question. We'll put it that way, as a flag to the situation. Recurring revenue is your friend. I'll add a fifth. That's always nice.
No, I'm telling you, that is great advice. I don't know that I ever had anyone talk about number three. So I'm going to flip that one again and say, does that mean when a credit union is talking to a fintech about investment, they shouldn't tie that investment to a bunch of customizations they want? Because that happens so often, especially in early stages. They'll be like, hey, we're interested, but we'd like to see a bunch of different things in there. Now, some of that's product feedback, but if every one of their fellow credit unions is doing the same thing, what you're saying is that kind of rots away a little bit. Maybe rots is too strong a word. Maybe scratches and claws a little bit away. Erodes is a better word than rotting. So that's what we'll go with. So when you quote this, somebody erodes, is that what erodes the valuation? Because you get pulled into these situations sometimes where you're trying to move to a product, but you keep getting customization requests.
Yeah, no, it's a balancing act. And again, it depends where you are in the life cycle of your organization. So to your point, if you're trying to get pilots up and running to proof of concept and things like that, sure, absolutely. You're gonna, it's either you don't get the pilot or you do customization, right? I mean, if you're in that binary situation, Kris, you got to make the right decision for where you are. All I'm saying is, as you build your storyline moving forward, try to make connecting points for the potential investors to show that each of those pilots, you might have done it differently, but it's all kind of funneling into this one concept or two concepts that you're trying to solve for. But you're right. It's a tough one. It's a tough one. It's hard to walk away if someone asks you for one more customization. I get it. But it does erode it. Standardization is helpful. We'll put it that way.
Yeah, no, that definitely learned that myself.
Yeah.
So you talked a little bit about acquisitions, right? That Capstone supports and helps credit unions with acquisitions. Talk a little bit about what that looks like in a CUSO world, right?
Sure.
So does a CUSO come to you and say, hey, I am interested in that particular firm? Do they come over and say, I'm interested in something in this space? What do those kind of engagements look like?
So yeah, a lot of different starting points, but to follow my own advice here about our core business, our core is really retained buy-side searches. So what that means and looks like is a three-phased approach. So we work with clients when they have the idea of getting into CUSOs through investment to build a strong foundation. What does that sandbox look like? What do we have to offer when we're going to approach organizations? What does the set of criteria look like so I can benchmark 20 opportunities and 20 prospects against each other and against the ideal criteria to see what's going to bubble to the surface? So we work through building those foundational elements and tools, if you will, for prioritization and focus. We also try to work diligently to define what is that one reason for acquisition. And the reason we do that is because most acquisitions that are written about in the press, the percentages cited by McKinsey and Bain and are 2/3 to 3/4 fail. But that's the larger transformational public deals, right? That's not the world that we're talking about here with CUSOs and privately held companies primarily. But we try to make sure that they're very, very focused on the strategy. Why am I doing it? And then, oh, by the way, that means you need to park these other reasons. And after you do one deal, you're a new organization and you may want to revisit that one reason, right? For example, I said, property and casualty insurance happens to be top of mind because I got several deals right now in the hopper for credit unions. So, we want to get into the property and casualty insurance business. What does that look like? Well, we need to define what's the business mix? What's the size? Do you want the entrepreneur leader to stay on? Do you want their team to stay on? Do you have certain carriers in your particular region that are going to be important to you? So defining all that, that's foundational. Then we flip the switch to say, okay, in phase two, we're building relationships, meaning we're going out in the not-for-sale marketplace and knocking on the doors of the agent owners, if you will, and convincing them and selling the vision that we've articulated with our client to them and explaining to them why they should be interested in having a new home within the credit union organization and becoming a CUSO. So we work through that process. Then, and that's meetings, data exchange. Then you get to terms. And then the third phase is really around the deal advisory or building the deal. So that's letters of intent, due diligence, integration planning, papering the deal, things like that. So back to my comment earlier about teaming up with the founder, that was the holistic view of what we could bring to the table. People certainly cherry pick, to your point as well, where they have a deal opportunity in hand or have somebody that they started conversations with, or they would like to start conversations, but for some reason they feel a third party could obtain additional insights and information and glean content that might be beneficial to the situation. Or they're already at negotiations and they can't see eye to eye on valuation. All those situations are fair game for us to parachute in and help as well on the advisory side. But the third, so those are the two scenarios. The third scenario is we don't even know we want to be in property and casualty, right? What we know is we believe that CUSOs can help augment our income, and we need that, back to my earlier comment. Or we need something to help with efficiency in our call center, right? So they're thinking through what the alternatives are and how CUSOs could fit in to solve those challenges. So then it's a matter of, first in the strategy formation, what are the concepts and ideas? And then how do we prioritize those ideas to get to where we're going to go searching? So for example, take commercial lending or business lending in general is one idea. Or we could get into real estate, or we could get into more consumer lending, or we could get into title insurance, whatever the ideas are. And some organizations start there, and we have to facilitate through a lot of sessions and use tools to help prioritize those ideas, right? Before you pick one to go hunting for the acquisition candidates. So those are the three different scenarios on the buy side.
So in that scenario where they don't have a target yet, but they have an idea, right? They want to do something in regards to back office efficiency, we'll call it.
Yeah.
Are there, getting back to that pre-vetting concept that we mentioned a few minutes ago, are there ones that you can go out of the gate with and say, hey, here's ones we've worked with other institutions, and here we know there's opportunities there? Or do you guys have to go out and do a search for, okay, well, who's out there? Because if that's the case, I will tell every fintech, when you see John Deering show up in your inbox answer that email.
Yeah. So our philosophy, Chris, is all of the above are applicable,
Okay.
right? So we want to build an identified pipeline and put everything in the top of that funnel that we can, that are sweet spot, remotely adjacent, everything in there, and then use certain criteria to whittle it down, as
Right.
opposed to only, look at 20 organizations and miss the other 30 that are out there where the two nuggets might end up being. Right. So we work with our clients and we ask them to give us what we classify as usual suspects, right? Ones that they kick around and talk about.
Sure.
And then based upon those usual suspects, and also we go through a role model exercise as well to learn about the characteristics that are important. Back to your risk profile, flipping it on its head. What are other characteristics that are important when you're growing your CUSO? And getting into the CUSO space, as the case may be. And we identify characteristics that are important. And then we're starting to say, okay, these are examples. These are some of the things that the client has said that's important on their roadmap that CUSOs can fulfill. Then we do, to your point, research. And absolutely, we hire people all the time that can do great research and can talk to anybody about anything, because those are the folks that are curious and can hold conversations with people. And part of their role at Capstone is to identify, things that our client hadn't thought about before, right? They may not end up being the number one and number two prioritized candidate, but at least it's allowing folks to compare and contrast. Because one thing I can tell you, if you only have one and you're talking to one organization, that's the one that's emotional. That's the one everyone's going to railroad through. That's the one people are going to start to rationalize to get a deal done. And what we try to do is force clients in a nice way to step back and say, okay, did you think about this, this, and this? And oh, by the way, if you have these 5 things that you must have, and this one's only got 2, maybe you should not railroad that deal through and think about others.
Yeah, definitely opportunity for potential target fixation if you're only looking at one.
Yeah.
You run right into it. Awesome. So where can credit unions and fintechs learn more about what you're doing? I think you've got a webinar coming up, right? With Becky Reed?
We do. We just did one with Ray Krause from Skyla about a recent transaction that we helped them with in the insurance world. Our next one will be with Becky Reed on April 2nd to talk about the evolving CUSO landscape. And then later in the year, we have our friend Brian Lauer and also Nick Evans from Circle as well lined up. So we try to do quarterly CUSO webinars for educational purposes for folks. In addition to that, we have a bevy of educational things on our website. I always direct folks to Brian Lauer's website where they have CUSO 101, content as well. If people are just getting started, we parachute in and get added to board strategy sessions all the time to educate on the landscape as well. So yeah, lots of alternatives. NCUSO, I'm a big fan of NCUSO as well. So I'll be at their conference in Vegas coming up again this I think it's in April.
So go ahead and share your website so that if people are interested, they know where to follow up with you, John.
Sure. CapstoneStrategic.com.
Super easy. Well, listen, thank you very much for joining us today, John. This has really been very insightful. And I think our audience is really going to enjoy the content and where it's coming from and the insights that you're providing. Thank you so much for joining us today.
Well, thanks, Chris. You had a great set of questions. I enjoyed talking with you.
Awesome.
This podcast is sponsored by Constellation. We're empowering community financial institutions with innovative digital solutions, powered by fintech, driven by your roadmap. Join us as we navigate the future of digital banking together. For more information on how we can be your partner for digital transformation, visit www.constellation.coop.
That really was a very insightful episode. There's like 4 new businesses in there that somebody could pick out and start to perform. So you're welcome, world. Thank you very much for joining us today. If you like the content, please like and subscribe on your platform of choice. Don't forget to check out our channel on LinkedIn. And thank you for being here. We will see you next time.